Good afternoon, everyone, and welcome to FintEdu's webinar on the domestic minimum top-up tax with regard to Bahrain. So, for today's webinar, we have Ajit with us. Ajit has over a decade of experience in this sector, and currently he's heading AJMS Global. He's heading the transfer pricing department of AJMS Global. I am Anu, co-founder of FintEdu. Ajit, over to you, please.
Thank you, Anu. So first of all, thank you for giving me this opportunity to present a very interesting topic on Pillar 2. So in next 1 hour, we'll understand the core concept of the OECD Pillar 2 and also the Bahrain's domestic minimum top-up tax regulations. So Anu has already given my introduction, so I'll not spend time on that because we have number of slides to cover. Now, I'll start with giving the broad framework of what is happening in the current tax landscape in the world. If I really talk about the cross-border tax landscape, tax is one of the most important source of revenue for any country. And no country would like to see any sort of base erosion in taxes. But if we really see in last 1 decade, the OECD has done significant efforts in bringing international standards when it comes to transfer pricing, when it comes to cross-border taxation. In 2015, they implemented the BAPS action plan. And then this BAPS Pillar 2, which is the biggest action for OECD, and number of countries, more than 100 countries have signed up to agree on this. Now, why this Pillar 2 concept? It is all about the race to bottom. More and more country in the last 2 decades would wanted to implement lower rate of tax, corporate tax, to get the more inflow in terms of the investments, to give more benefits to the MNEs, to get overall more business. And that's overall created harmful tax competition because the country has 40% corporate tax. It's very difficult to compete with the country with 10% tax. And that's the reason there's an unfair advantage which is being taken by the MNEs across the world. And it has been seen that while there are transfer pricing regulations in place, but when it comes to the minimum taxation which a country should offer on a global standard to bring every country on an equal footing, there has to be a minimum tax for each country. And that minimum tax agreed by the OECD is 15%. So that is a race to bottom. It was the race, and it created a harmful tax competition between the countries, and due to which this resulted into a Pillar 2, which introduced the global minimum tax of 15%, level playing field, prevent harmful tax competition, and stabilizes the tax revenue, increases the fair global taxation. So more and more countries are coming up with these regulations. And we'll talk more about it, which are the pillars of which are the core element of the Pillar 2. And many of the GCC countries have already either they announced implementation of the Pillar 2 or they enacted. Bahrain is the first country which has enacted the Pillar 2, the domestic minimum top-up tax. And subsequently, UAE has already announced it is going to come up with the regulations soon. Kuwait has come up with the draft regulations. Oman has already announced. The only country which is not yet made an announcement is the KSA, which will also be part of this. So there is a significant active things happening when it comes to the BAPS Pillar 2 and its implementation, because the countries would want to be a part of the global initiative to bring all the countries in the level footing and bring more trust at a global level. So this is all about the broad framework of the why there is a global minimum tax. Now, coming on to the key element of the globe rules is one is the qualified domestic minimum top-up tax. Second is the income inclusion rule. These are the 3 key elements. And third is the under-taxed profit rules. When we talk about the application flow start with any country's corporate tax, and then it will continue with the QDMTT, then IIR, and then UTPR. So today we are going to discuss broadly the QDMTT part, which is implemented by Bahrain by introducing the executive regulations. IIR is no country is no in the GCC country, there no country is going to implement IIR, and there's an under tax profit rule. So QDMTT is basically a tax which is implemented and collected locally. Income inclusion rule, which is a tax, low tax subsidiary profit ultimately collected at a parent entity level. So if let's say parent entity is based in UAE, just I'm taking a hypothetical example, and there's a shortfall in the tax in the subsidiary based in let's say KSA, that shortfall is collected by the UAE. So that is all about IIR and UTPR, where IIR is not applicable. This is UTPR. So we'll discuss shortly all these different mechanism, but we will broadly discuss the session the QDMTT part. Now, before I move, it is important to mention that currently the Bahrain regulation is the domestic minimum top-up tax. It is not qualified domestic minimum top-up tax. So there's a difference. Any regulations becomes a qualified domestic minimum top-up tax when it is aligned with the globe rules. So there are standard globe regulations introduced by the OECD. And when any country introduces the regulation regarding the DMTT, it is to be reviewed by a peer review committee of the OECD. And once everything is aligned within the framework of within the set of period of time, then those are considered as a qualified domestic minimum top-up tax. Currently, the regulations are domestic minimum top-up tax, and hopefully going forward, it will be a qualified domestic minimum top-up tax. Now, moving forward, as I said, the first flow is the QDMTT. Second is IIR. If QDMTT is not there, then IIR. IIR mainly parent entity level, and then UTPR. So IIR is basically if parent entity is applying IIR, then whatever the shortfall of other jurisdiction entities, that is collected at a parent entity level. So this is all. I'm not going into much detail of this mechanism because this is a complete different set of mechanism for the application of the Pillar 2. Today we'll broadly discuss the DMTT part only, but just for your information. Then comes to the UTPR, the last mechanism, which is where if parent entity is not qualified for IIR, then wherever the shortfall, let's say in this example, there's a parent entity and there's a low tax entity, entity A, entity B, where it is not meeting the 15%. Now, whatever the shortfall is to be collected at the level of entity which has the tangible assets and the employees, where the substance. So this is again the mechanism where IIR is not applicable. But as I said, I'll not go into too much of detail into this. Today's our objective is to discuss broadly the Bahrain's regulations, which is on the qualified domestic minimum top-up tax, where any constituent entity, let's say an entity based in Bahrain, which is a part of the MNE group, is if it is less than 15%, whatever the shortfall is to be collected locally only. It will not be collected anywhere else. And that's the best part of the QDMTT, that it protects the key rights to collect the taxation. So that is all about the DMTT. Now, this is the broad framework of the Pillar 2 and why Pillar 2 is required and which are the elements. Now, coming to the scope of the law and executive regulations. So last year, Bahrain introduced the draft law, introducing various provisions about the implementation of domestic top-up tax. And recently, they have introduced the executive regulations. So executive regulations are more of an operational thing. They can be changed easily. It's not easy to change the law, but yeah, so executive regulations are more broad and wide, around 160 pages. For me, so I have tried to cover which are the key points to understand the broad framework, to understand the ETR mechanism, so that we can understand clearly end to end what details we need to see, what sort of analysis we need to make, and what are the overall implications. So it is around 160 laws. Every provision has a different requirement. There are different level of adjustment are discussed. So we will not touch upon too much of detail into that, but we will broadly discuss the key framework. So it is applies to the regulations applies to MNE group meeting the euro 750 million consolidated revenue. We'll discuss how this will be applicable and how it is computed. Constituent entity must be appointed if there are multiple entities to file the return to pay the tax, and 15% minimum rate of tax is applied in Bahrain. If it is below 15%, there will be top-up tax. Now, there might be one question come that there is no corporate tax in Bahrain, then everything would be 15%. Like, why? How there will be a top-up tax then? See, the point here is that, yeah, there is no corporate tax in Bahrain. There's no separate tax. The effective rate, the minimum rate is 15%, but the ETR, the tax rate can be different based on some adjustment, not based on the corporate tax because there's no corporate tax rate, but based on some covered taxes, let's say withholding tax or any adjustment, the tax rate would be different than 15%. So whatever is shortfall is to be part of the domestic top-up tax. So we'll understand how this will be computed. This we have already discussed that what is the objective of the domestic minimum top-up tax. It protects the right to collect the tax that the other country would not be able to collect on behalf of the shortfall entity. Wherever there's a shortfall, let's say there is a entity based in Bahrain, any part of the large M&E group, any branch or PE in Bahrain, whatever the shortfall of the tax is to be collected by the NBR only. It cannot be collected anywhere outside the jurisdiction when we talk about the QDMTT. Now, taking a simple example here, that if let's say the ETR in Bahrain is 10%. I'm taking a hypothetical example. It not might be 10% because there is no corporate tax. There might be tax adjusted covered taxes on account of some other reasons. But let's say the tax is 10%. Pillar 2 minimum rate is 15%. Top-up tax is 5%. So top-up tax amount is 500,000 US dollar. Now who collects? So let's say without DMTT. So there's no DMTT in Bahrain and UAE has IIR, assuming. So then whatever the difference is to be collected by the government by the entity in that country, UAE. But if it is a DMTT in Bahrain, whatever the shortfall is to be collected by the Bahrain only. So this is the benefit of the QDMTT, that whatever the shortfall, it does not go outside the country, whether it is a JV in Bahrain, whether it is a branch or it is a UP or a subsidiary. If it is a constituent entity, whatever the shortfall is collected by Bahrain only. Now, before we move on to, it is important to understand some of the basic terms. Entity defined as legal person arrangement which prepares the separate financial accounts. I've not covered the detailed definition. Then constituent entity, which is an important term because constituent entity is is the entity which goes for registration of the under this law, filing of the taxes, and this entity is a part of the M&E group. One constituent entity is appointed on behalf of all other entities. Then ultimate parent entity, which owns the controlling interest. Then there's a main entity. Main entity means there's a P in entity that includes P's income and loss statement. So there is a entity in UK which is and with P in Bahrain. So main entity is UK. It might not be the ultimate parent. This is called as a main entity. And then there is a M&E group, which is a group which 750 million euro threshold for evaluating whether these regulations are applicable or not. Now, this is very important to understand that how we identify whether any entity is whether these regulations are applicable or not. So the requirement is that in at least 2 of the preceding 4 years, the revenue should be consolidated revenue should be of the entire group should be 750 million. So let's say in the first scenario, the consistent high revenue means every year 750 million, then no threshold adjustment is needed. So there is a provision in the law where the threshold can be adjusted if the financial is short or financial is extended. Second scenario, out of 4 years, in second and third year, it is crossing the threshold, so no adjustment needed. There is a short fiscal year where in 2 of the years, the threshold, the financial is only for the 6 months. Then this threshold of 750 million is adjusted to 375 million. So if it is crossing, so our threshold is 375 million. If the consolidated revenue is crossing this, then this is applicable. And suppose in the fourth scenario, year 1 and in year 4, if it is crossing 750 million each year, then the threshold is adjusted to 938 million because the financial is extended for 15 months for each year. So this is how we need to adjust the threshold based on the financial, but the overall threshold is 750 million euro. Now, there are entities which are excluded in the regulations, like government bodies, part or owned by the government, international organization, part of the IMF, but primarily comprised of the government bodies, government representative, non-profit organizations, pension fund, investment funds. So these are the some of the entities which are excluded. Now it is very important to understand why these are excluded, but when we determine the threshold for 750 million euro, we need to include the entire revenue, including these revenue from these entities also. If one of these entities are a part of this is to be included. But the pillar 2 ETR will not be applicable on these entities. So and for each of these entities there are various rules prescribed under the executive regulations. So I have not covered specifically those, because today we are going to cover the broad framework of the pillar 2 or DMTT in the Bahrain. But it is important, if someone wants to understand the detailed requirement, one should go through the executive regulations. Now, the first thing is that the revenue test of 750 million euro, that how do we apply the revenue test? The revenue from the economic benefit, ordinary activities, production of goods, services based on the consolidated financial statement. Now, there are some adjustments required, like realized and unrealized investment gains, extraordinary and non-recurring item to be added, all revenue types not be aggregated. So this is something we need to understand while evaluating the computing the 750 million euro threshold, that all these items to be considered. There's a special case where newly created M&E group without 4 years of statement. So there is a no financial statement of 4 years, preceding 4 years, then it is deemed, for some practical reasons, then it is deemed that annual revenue not to exceed euro 750 million, and then provision not applicable. So again, there are some conditions which I have not discussed here. But the idea is to mention that there are some exemption if the financial statements are not available for the last 4 years, then there is an exemption here. Coming on to the permanent establishment. Now, I'll not go into this slide in too much of detail because this is a generic part of the PE and it is more or less aligned with the any tax treaty definition or any regulations definition coming under the transfer pricing, that which are the entities are the permanent establishment. The point is that even if an entity is a PE, only there is a branch in Bahrain and part of the larger M&E group, let's say head office is based in India, then also the ETR is to be computed for that PE to see whether there is a 15% minimum tax is there or not. So this is important to understand. Now, location for multi-jurisdictional entities. Now, there are entities which are part of the different jurisdictions, and sometimes it is difficult to identify which is the resident entity, which is not. So how do we determine whether that entity is qualified to become a constituent entity or not? So it is important to understand that if entity which, as per the tax treaty between, if there's a tax treaty between two countries, so as per the resident of the tax treaty to be considered. So if there is a tax treaty between Bahrain and another country, we need to see the tax treaty, and based on that criteria, we need to see the residency, that this entity is a resident of Bahrain as per the tax treaty. If there's no treaty or agreement, then there's a priority order, either to evaluate the higher tax rate jurisdiction. So let's say the cover tax. So let's say the cover tax in UAE or Bahrain is higher, then that entity becomes a resident of the Bahrain. And then the higher substance-based income jurisdiction. So if you not cover tax, then second criteria is a substance-based. If these all are equal, then if it is a UP, then where the UP is created is to be determined in that jurisdiction. And then if it is all not fulfilling all these criteria, then it becomes stateless entity. Like there's no, like for the stateless entity, again, the ETR computation required, but it would be a separate computation. It will not be part of the jurisdictional blending with the all other entities. So say, for example, there are 10 different entities in Bahrain, and one entity is stateless, means no residency. Then there's a separate ETR calculation would be required for that entity, and it will not be part of the all other entities. Now, we'll discuss the core mechanism of ETR and the globe income and the adjusted cover tax. But before that, it is important to mention about the financial income net loss. Now, the first primary method is to consider IFRS local standard if all conditions are met. But for some practical reason, if all entities are not under IFRS or some, then the secondary method is consider the ultimate parent entity's consolidated IFRS and use net income loss before elimination of the intragroup transactions. So based on the UP consolidation related financials. And then if this does not applicable, then there's a fallback method which says that any acceptable financial accounting standard, for example, US GAAP, can be applied here, provided if this difference is more than 1 million pound must be conformed to the UP standard. So like if it is more than 1 million pound, then it has to be conformed to the IFRS level. Otherwise, this can be managed with the US GAAP. So this is a general standard in terms of set by the regulations that what sort of financials we need to focus into when evaluating the 750 million threshold. Now come to the core mechanism of this QDMTT. So this is the formula that ETR, the effective tax rate. Now there is a minimum tax rate of 15%, okay? And there is an effective tax rate. So if the effective tax rate is, let's say, 12% and minimum is 15%, then there will be 3% top-up tax to be collected by the Bahrain. So 3% top-up tax. If the ETR is more than 15%, then your minimum would be your 15%. So this is how we determine the domestic top-up tax. What are the practical steps in determining the top-up tax calculation? The first is the jurisdictional blending, which means the including overall adjusted global income by doing some adjustment, let's say dividend, we'll talk about those, and including all covered taxes for all the entities, and then computing the ETR by dividing the adjusted covered taxes divided by the net globe income. So we get the ETR. So let's say ETR comes to 3% because there's no corporate tax. So the ETR might be minimum because of some adjustment. So the 12% would be the domestic top-up tax would be applicable on this net globe income, which is the globe income of the overall constituent entity's income. But before we do that, we need to reduce the substance-based carve-out. So the process is like this. If we, let's say, have 5 entities in Bahrain, we combine the overall income of those entities, adjust those income based on some parameters given in the law, combine the covered taxes, adjust the covered taxes based on some parameter, compute the ETR. That ETR we apply to the adjusted income. But before we do that, before we apply that, the income should be reduced by the substance-based carve-out, which we will discuss in the subsequent slide, and then accordingly we'll get the amount for the top-up tax. So we will have the case studies we will discuss. So this is a broad parameter how we compute the effective tax rate and also the domestic top-up tax. Now, when we have the financials or constituent entity income for all the entities, the first thing we need to do the adjustment to all these entities income. Now there are different type of adjustment being discussed in the executive regulations. I'm not going to discuss all these because this is the first year of regulations, and because we have limited time in this webinar, it requires a lot of time to discuss and understand. But the point is that we need to understand all these points in detail and then adjust the income accordingly. So let's say deferred tax. So because this is the first year, there were no corporate tax regulation before. So there might not be a deferred tax situation. There might not be a permanent differences situation because there is no different provisions for the corporate tax and accounting books. So, but might be there will be separate regulation introduced, and from that perspective, there are many items which might be relevant. But at this point of time, we need to understand and keep in mind when we need to adjust the income of the entity. While I have discussed all these items, that what is the nature of adjustment and example, but because of the lack of time, we are not going to discuss this. But the concept here is that the moment we have the jurisdictional banding overall income, we need to adjust based on these parameters. Can be deferred tax, it can be permanent differences, can be dividend, it can be portfolio shareholding, equity gains, losses, so various parameters, and then we come to the adjusted income. Okay, so this is the part where we talk about the net globe income, the adjusted globe income, where we need to do a lot of adjustment. Then comes to adjusted covered taxes. So if you see this slide, adjusted covered taxes, how we compute, again like income, For tax also, we need to do a lot of adjustment like deferred tax, uncertain tax position, refundable tax credit. Some of these are not yet prescribed, yet not prescribed under the executive regulations. These are basically covered in the regulations to make it very wide going forward if there are some clarification being issued. So there are some adjustment to be made in the covered taxes. Let's say withholding tax paid somewhere outside a country by the Bahrain entity, and that needs to be included. Some CFC taxes. So there are various taxes to be adjusted and to be subtracted if this is, let's say, excluded entity income, uncertain tax positions. So these all adjustment to be made, and then we come to the adjusted tax position. So this is a very simple example where we start with the accounting profit, and then there is a tax, and then there is a current tax, which is this. Because there is no addition during the year, other than the uncertain tax position, the final adjusted covered tax would be your overall current tax less your uncertain tax position. So this is how we compute the adjusted covered tax, assuming the, let's say, current tax is 15%. I'm just assuming. Now, we talked about the effective tax rate. We talked about the adjusted covered taxes, adjusted income. Before we compute the domestic top-up tax, which is the effective tax rate minus the global minimum tax, that rate needs to be applied to the adjusted income, but that adjusted income to be again adjusted by reducing the substance-based carve-out. So let's say after doing all adjustment, my overall income is 1 million, but out of that 1 million, I will do some reduction based on the rate prescribed under the law. And let's say 10 million, let's say 100 million is my overall income, adjusted income, and 10 million is the substance-based carve-out. So the difference of the minimum tax, which is 15% in ETR, let's say 10%, that 10% is applied only on the 90 million only, not on the 100. So this is important to understand the provisions of the substance-based carve-out. This is aligned with the GLOBE rules. Now there are various rates prescribed. It is to be computed on the payroll cost and eligible tangible assets. Now they have prescribed the rates from 2023, not relevant because the regulations implemented from 25. So we'll consider this, let's say for 25, 9.6% and 7.6% on the payroll cost and tangible assets. Now how we compute the eligible payroll cost? There are some mechanism prescribed that which are the component for the payroll cost, which are the component for the tangible assets. When we do these calculations, to compute the absolute amount, we need to consider these amounts based on these parameters, and then finally arriving at a number which is to be reduced from the adjusted income. And on that number, the difference would be applicable. Difference, that is difference coming out from the minimum tax of 15% minus the ETR. So this is the substance-based carve-out. Now there is a provisions for de minimis exclusion. So there is a provision, and there is to be elected every year, where the entity can get exemption for no need to compute the ETR, no need for domestic top-up tax if there is a minimum threshold is met. Let's say average revenue is less than 10 million pound, which is in fiscal year plus 2 preceding year. So the fiscal year and 2 preceding year, if the average revenue is below this, then, and there's one more condition, average constituent entity income or loss less than 1 million. So if these conditions are met, then there is a benefit in the law to apply de minimis exclusion, where no need to compute the ETR, no need to apply domestic top-up tax, but a tax return to be filed, because the Pillar 2 regulations are applicable because the 750 million euro threshold is met. So the entity needs to file do the registration, but filing the return, this election to be made every year that I'm applying for de minimis because I'm meeting this threshold. So for me, this de minimis threshold is not applicable. Okay, so this is important to understand. Computation of the effective tax rate. Now, when we do the jurisdictional blending of the various entities in the region, in Bahrain, there are situations where we need to do separate calculation, not the jurisdictional blending. Let's say stateless entities, joint ventures, minority-owned constituted entity, investment insurance entity. So in this situation, there's separate calculations required. and registration and filing would also be the separate. So I have also discussed this separate calculations of the ETR, stateless entity which assigned not assigned to a particular jurisdiction, joint venture, jointly controlled by multiple parties, minority owned entities, and investment entities, flow through entity. Flow through entity is basically fiscally transparent entity, let's say partnership, where ultimately tax in the hands of partners. So again, the separate calculation required for the ETR. Now come to the case study part for the Bahrain DMTT regulations. So in this case study, basically, the ABC Manufacturing is a constituent entity in Bahrain, part of the global manufacturing group, and it has manufacturing operation with significant tangible assets and employee in the country. Based on the 2025 data, the financial accounting net income, which is 40 million, payroll cost is 8 million, carrying value of the tangible assets is around 20 million, and current tax expenses zero because no corporate tax. Now, in this situation, we start with the 40 million because there is no deferred tax. So, and there is no basically adjustment to the income. There's no item where this income needs to be adjusted on this. There's no other item like permanent differences or any withholding tax to this income or taxes. We take directly this adjusted income 40 million. Now, because this is the adjusted income, we need to reduce this by the substance-based carve-out on the rate prescribed 9.6% and 7.6%. So the 2 million is the substance-based carve-out. So out of the top-up tax would be the 40 million reduced by the 2 million, which is the substance-based carve-out, and the entire 15% would be your top-up tax, and this much amount tax to be paid. So here, if we really see, there are no item where the income needs to be adjusted. In this study, there are no item where tax needs to be adjusted because there are no item for the tax. There is no corporate tax in Bahrain. There is no like deferred tax or withholding tax. So no adjusted covered tax. So the entire my minimum tax should be applicable, which is 15%. But before I do that, I need to reduce the substance-based carve-out, which is 2 million. So this is how it works when there is no item for the adjustment. Suppose there is some item in the adjustment. Taking an example, same example, where there's a dividend, there's a withholding tax for the distribution of dividend to the parent. Now that withholding tax would be actually the covered tax. So the covered tax divided by the income, which is the 40 million. Again, there's no item to adjust the income. So I will directly compute the ETR, which is 0.625, and then the 15% is the minimum, and this is the cover tax. So 14.37% is to be applied as a domestic top-up tax. Now, to apply this, we need to reduce the substance-based carve-out, which is the 40 million reduced by this payroll and tangible, and then accordingly apply the 14.375% on the rest of the amount, and that would come the top-up tax to be paid in Bahrain. So this is how, when there is some adjustment to be made. See, these are very simple example. If we go to the law executive regulations, there are number of adjustment mentioned. Some of the adjustment might not be relevant to this year, might be next year, let's say deferred tax or some other adjustment. So we need to keep in mind all this, and as and when there is more clarity in the law, we will see more analysis or evaluations to be done in this exercise before we finally reach out to the top-up tax calculation. So this actually requires a lot of work, starting from the understanding the financials, computing the threshold, and then jurisdictional blending, adjusting the income, adjusting the tax, and computing the ETR, and then top-up tax rate, and then finally applying the top-up tax rate on the globe adjusted income reduced by the substance-based carve-out. So to make it more clear that, just to summarize it broadly, okay, so these are just the adjustment mentioned on an example basis only. There might be different adjustment also, but on a broad level, start with the financial statement, then selection of the financials. If it is a IFRS, then we need to go with the IFRS, and then doing the adjustment in the income, adjustment in the tax, and then calculating the substance-based carve-out, and doing the further calculation and finally arriving at the final amount for the top-up tax calculation. So this is how the entire framework works as per the regulations. Now, so far we discussed the objective of the pillar 2. We discussed the objective of the DMTT, how it is helping the companies to protect the tax base in the local jurisdiction itself, how it is applicable, to whom it is applicable, how to check the threshold requirement, and then computing the ETR, computing the adjusted income and adjusted tax, and finally deciding the domestic top-up tax after considering the substance-based carve-out. Now, there are some other provisions in the law in terms of giving more relief to the taxpayer. First is the transitional safe harbor, which is applicable from 26 to the window period is any financials starting on or off before 31st December 2026, but not after 30th June 2030. There are some threshold because we have a number of slides to cover. I'll not discuss this threshold in detail, but there are some threshold prescribed. And once these threshold are met, then again, these safe harbor provisions, if the entity meeting this threshold, then there will be relief in terms of the computing the ETR. And then there is a simplified safe harbor mechanism. Now, simplified safe harbor mechanism, there are some threshold prescribed under the law. And in the executive regulation, it is mentioned that the separate conditions will be prescribed for this simplified CBCR calculations. So sorry, simplified safe harbor calculations. Now, this is the provisions where, let's say, M&E group in Bahrain is the total CBCR profit or loss of M&E group in Bahrain is equal to less than the substance-based carve-out. And then there are some other threshold prescribed under the law, but then we are still waiting for the final regulations on this. So we'll not go into detail, but this is one of the, again, regulations prescribed to get to provide relief to the taxpayer. Then one more relief is provided to the taxpayer in terms of the initial phase exclusion. So if the entities are into initial phase, let's say M&E must operate in not more than 6 jurisdictions. So the first requirement is that it is not operating more than 6 jurisdictions, the entire M&E. So this is the first requirement. The net book value of the tangible assets in all jurisdictions must not exceed euro 50 million. So this is the second requirement. Constituent entity in Bahrain cannot be owned by a parent entity subject to IIR indirectly. So if any entity, let's say in Bahrain, is owned by or group which has applied the IIR, then this exemption is not applicable. So again, this is a kind of an initial phase exclusion. This is to be applied, and if any entity or group in Bahrain is forming part of these conditions, then this can be elected, and there will be exemption on computing the ETR. There would be exemption on computing the domestic top-up tax. Now, there are various conditions prescribed for initial phase exclusion, how to compute the book value of the tangible assets. Again, I will not go into too much of the details, but it is important to go through the executive regulations that when we determine this threshold, what is to be considered and what not to be considered. And then once we follow these parameters, then only we should conclude and then apply for this exclusion. There are various relief provided. One is de minimis exclusion, which is explicit. One need to elect. Transitional safe harbor, which is automatic. Simplified safe harbor, again automatic, but we are still waiting for the rule. Initial phase is also automatic. So de minimis is something one need to elect in the while filing the tax return, and there are threshold prescribed. And if it is if everything, all the thresholds are meeting, then the entity can be excluded from domestic top-up tax. So likewise, the summary is given for all the other reliefs. Now, there are different elections in the executive regulation. There are some elections which are annual, like de minimis, every year substance-based carve-out, loss election. There are 5-year election, stock-based compensation, non-excluded entity treatment, and there are automatic elections. So one need to see where any entity falling into the place and accordingly apply for these elections. Then comes to the important part of the transfer pricing. See, transfer pricing was not part of Bahrain's regulations when the law was introduced last year. Now executive regulation introduced. Transfer pricing is part of the executive regulations, and it is applicable to the constituent entity which is part of the larger M&E group. So if any entity, let's say even is a smaller branch or an entity which is a part of larger M&E group, even smaller transactions, then the local file requirement is there, which means that the transaction between the related party to be computed based on the arm's length principle. There are prescribed method to determine the arm's length price. Local file and master file to be prepared. See, master file is anywhere prepared at a group level, headquarter level, but then this required to be submitted at a local level also. And then there are special consideration mentioned in the regulations in terms of the APAs recognizing for ETR calculation. So this is interesting because generally APAs are for transfer pricing, but here APAs are also recognized. Bilateral, multilateral agreements are considered. Intergroup loss adjustment required. Arm's length principle is mandatory, applicable to the constituent entity. Cross-border transaction is the focus. So this is the broad parameter. And when we talk about the adjusted income, before we really finally reach out to the adjusted income before substance-based carve-out, we also need to see, is there any adjustment to be made on account of transfer pricing? Let's say policy is cost plus 10%, but the benchmarking is coming at 15%. The policy is lower based on the functional analysis, and any adjustment to be made in the global adjusted income. So this is the broad parameters, broad overview of these provisions. Now comes to another important part of the registrations and the tax return. Now there would be a filing entity. An M&E group must designate one constituent entity in Bahrain to handle the tax administration, filing, registration, notification. JV entity should also do, because it is a separate calculation. So JV entity should also do the same. Registration requirement. So the registration requirement is that 120 days from the end, from the first day of the transaction, from the transitional day, or 30 days from the law effective days if revenue met in 2 of the 4 preceding year. So here there are 2 different type of scenarios. If an M&E group where 750 million euro is meeting for 2 after the 4 preceding year, then the registration deadline is 30 days from the law's effective date. If it is not, let's say in the first year only, not out of 2 of the 4 years this is meeting, but in the first year it is meeting the 750 million euro, then the due date would be 120 days from the first day of the transition year. Now, tax return due date. So this is all about, we will talk about various scenarios about the registration. Now, tax return due date. Now, the return must be filed within 15 months from the last day of the fiscal year, the 15 months, the last day of the fiscal year. The fiscal year is the December 2025, then from 15 months. Tax return must include tax computation schedule, information schedule. Now, this is the there are various scenarios. One is the entity is meeting the threshold, then registration is required. It must register within 120 days of the transitional year. Meeting threshold, joint venture, same registration requirement. Meeting threshold, excluded entity must register but exempt from tax. Below threshold, let's say entity is below threshold, no registration is required. Meeting threshold is 2 out of the 4 preceding years, must register within 30 days of the law's effective date. Threshold not met for 5 consecutive years. So then if any previously registered entity, then it must re-register. Meeting threshold, multiple entities in Bahrain, again the same scenario. Meeting threshold but part of the M&E group, entity in Bahrain, no register unless group voluntary requests. Because it is a below threshold, but part of the M&E group, so no registration is required. Now, there are some other provisions, let's say payment requirement, advance payment required quarterly, final payment due within 15 months and fiscal year, choice between prior year method and current year method for the advance payment. And then there are provision for the tax refund, record keeping. Record must be maintained for the 5 years for fiscal years. Real estate and capital assets record must be kept for the 10 years. Annual election is de minimis, debt religion elections, loss elections, immobile property gain elections. So this is an annual election. There are 5-year election we already discussed. So these are the more of administrative provisions. Then there are penalties are being prescribed let's say failure to register or apply for registration using the incorrect information, failure to comply with administrative and compliance requirement, late payment of the tax, late filing of the tax, and the tax evasion. So there are various penalties are prescribed. Now, so these are the broad framework of the entire executive regulations. Now there are various, because as I mentioned, it is a 158-page regulations. There are various other things mentioned, conditions mentioned. The objective of the today's webinar is to give you an overview of the objective of the pillar 2, objective of the DMTT, how it start, what are the outcome, what sort of adjustment are required, and what are the registration requirements. So this is the overall framework of the law. Now comes to the operational challenges. There are various operational challenges the law has implemented recently, and it is very high time to do the first of all do the impact assessment, because this is not a straightforward exercise. Uh, if any group is based in Bahrain and there's implementation of the requirement for the DMTT, it is not only just computing the ETR. There needs to be an impact assessment, understanding the overall impact, if any changes to be done in the business, overall impact on the tax flows, what any changes to be made in the supply chain, all those provisions to be all those things to be evaluated looking into the by performing the impact assessment. Now impact assessment considering the current structure of the entities, business, overall tax impact, transfer pricing. So it all start with the data first, the looking at the all the data of the all the entities, and then looking into the related party transaction, transfer pricing, then whether there's any adjustment to be made from a transfer pricing perspective or not. If not, then understanding the what is currently effective tax rate by computing the adjusted tax income, what is the covered taxes, adjusted covered tax, ETR, and finally coming out with the overall impact that if based on the today's structure, what would be the impact on the overall group, and also understanding the applicability. This is very important. And this exercise is not to be seen only from a DMTT perspective or from one jurisdiction, while all calculations and everything to be seen only from a Bahrain's perspective. But when somebody seen from an entire group perspective, in any other country, if there is any other, let's say IIR or any other, while the taxes used to be collected in the local Bahrain only, but there needs to be reconciliation to be made at a group level in terms of the overall taxes and in terms of the substance-based carve out. So this is an overall group level exercise to be evaluated on a holistic basis. And there are a lot of challenges in terms of the data integration, compliance, and Bahrain specific adjustment also to be evaluated, system limitations. So as I said, this is not a straightforward exercise. One also need to see the system from where the data is coming, whether data is correct or not, all the costs are captured properly, all the systems are captured properly, related party transactions are covered properly, pricing policy is covered properly. So one need to see the systems also. Then also monitoring and reporting requirement. Once the all exercise calculation is done, then regular monitoring. Is there any changes made during the year in terms of overall tax impact, any new transactions happening which has resulted into the ETR calculations? And then resource constraint and specialized knowledge. This is a new regulations. While it is implemented in the various countries in the GCC, is it a new knowledge? It requires special trainings. So resources are also very important. So keeping in mind all these things, this is not to be seen only from a compliance perspective, tax perspective. This is, I would say, a broader exercise, not only from a tax, but overall business strategy perspective, and to be seen as a subject of the corporate governance, because a significant impact would be there if we don't look into all the aspect on a holistic basis. So this is how we see from a this entire regulation from a strategic perspective. What is the way forward? The way forward is that understanding the data and internal control reporting framework, that where as an entity I am fitting into. If I am an entity which is a part of the group and I can easily claim benefit of the de minimis or some other safe harbor, I should look into that, and accordingly then if I am not fitting into that, then I should make an effort to do the impact assessment, because understanding the law and getting the maximum benefit out of the provisions of the law is very, very important. And for that, understanding the basic threshold of these provisions are very important. And then upskilling and resource allocation is also important. Proactively engage with the regulatory updates. Every law is very new, and when we have seen in the UAE also, so much of guidelines issued, various notification issued. Similarly, we are expecting more and more clarifications, guidelines, because it will evolve over the period of time. And when it evolves, we need to keep in mind the regular updates from NBR about the issues, about the type of adjustment. And last not the least, conduct dry run calculations and the audit impact assessment, that whatever how much is the overall impact when it comes to the overall implementation of the group from a strategy, not only from a cash flow perspective, but from a strategic perspective. So I think broadly, I have, though there are number of slides to cover, I could not cover every slide in detail because of the lack of time. This required a detailed session in terms of understanding the adjustment, understanding the key provisions, each and every nuances in terms of the looking at the detailed executive regulation, which is 160 pages. But I'm sure this presentation will give you a broad overview in terms of what is to be covered and what is not. And this will make you aware that what is the action point at this point of time. People will try to implement this, on a system, at a ground, when they actually applied on their company in terms of implementing the ETR and actual globe income calculation.
Thank you so much for this wonderful webinar. And to all the participants, thank you so much for joining in. We'll be sharing a recording of the webinar and a very short summary. We'll be sharing with all of you. And thank you, Ajit, once again for
Thank
this
you very much.
very
Thank you
wonderful
for the
session.
opportunity. Thank you very much.
Thank you, Ajit. Thank you, everyone.